Hello investors, last week was very exciting for the market. First, the S&P 500 has entered into corrective territory. This means that it is trading 10% off or more of its recent high. So corrections sound scary, but we've been here before. This is not the first time that a podcaster has panicked over the stock market or CNBC has run markets in turmoil special. Actually, since 1950, the S&P has dropped 10% or more 34 times, which is about once every couple of years. This is on average, of course. This time around, the S&P 500 took just 22 calendar days to drop 10%, making it the 7th fastest correction in the past 7 decades. So remember those 34 corrections? Only about 1/3 turned into market crashes, which is 20% or more drop. Wall Street calls this a bear market, so in 23 cases the drop stayed below 20%, and ultimately these were just blips on the long-term investing journey. Only 4 out of those 23 corrections, which are drops between 10 and 20%, coincided with economic recession. And while 7 out of the last 11 crashes are larger than 20% and overlapped with a recession. And at this point, keep in mind that the job market and spending data are not necessarily bad, and they can even get worse, but the market will likely weather this. Earning estimates for 2025 has stayed surprisingly strong. And keep in mind that corrections don't last forever. Since 1950, the S&P has taken an average of 3.5 months to recover its losses after a correction, and no recovery has taken longer than 9 months. So generally, you have not had to wait more than a year to make your money back from a correction. Right now, the corporate buybacks and retail activity have been providing some of the basically little liquidity available in the market, and hedge funds have remained net short. So keep this in mind, but corporate buyback window is closing, and in a few days this could dry up the buying pressure even further. The key takeaway is that big fund money is still not buying, and we're also seeing a move lower on Fed's Goolsbee, who said tariffs raise prices and reduce output, which of course is a stagflationary impulse. The hard data right now are not stagflation of the 1970s, but it is uncomfortable when inflation and unemployment are both going higher. So what are my expectations? Well, basically, my expectations are that the current moves do not seem like a full-blown recovery, more of a liquidity grab before another leg lower. So S&P saw its volatility drop last week, but that gave the index a bit of a breathing room. But it is still trading under the 200-day moving average, and it's failed at key resistance levels. Even the 200-day EMA is curling down, so this is definitely not optimal. So a couple of bullish signs, but we're still in a tricky technical zone. So that's the S&P. Moving on to crypto. There isn't too much happening with Bitcoin, some just choppy price action near the 200-day moving average. For those following, if you are bullish, check out the weekly charts both for Solana and Bitcoin, which are testing key support levels. And please know that we do need to close above those levels, as well as this trend line you are seeing on screen now. That's 5 minutes. Just switch to daily. Yeah, you can see the levels here. So let me just go to the S&P real quick. You can see the levels I'll be looking at this week, which the main resistance is actually 5710, 5780, 5800, and we are likely to find some support at 55.24, and if this breaks 54.04. Okay, so let's get to gold. Gold sliced to above 3,000 per troy ounce, and I am seeing more bullish flow come in last week, and traders are long on most of gold related stocks. And what needs to be noted here is that positioning is highly supportive, and fundamentally weakness in US growth and geopolitical unrest are fueling strength in gold prices. Also, if you look at the chart, we are seeing a retest of the support level at $3,000. These types of retests tend to be bullish, and with enough patience can be promising. Okay, speaking of geopolitical unrest, we are seeing tensions rise in the Middle East, particularly the breakdown of the ceasefire in Gaza and the issues in Yemen. This leads us to oil, and what I am seeing is that positioning has increased sharply. So I tend to use US oil as a proxy, and I am seeing some very nice buying on the level of 76, and this indicates that traders do expect a bit stronger oil price action. And additionally, the skew is pointed high on both Brent and WTI, and this shows that sentiment in the oil market is becoming more and more bullish. For the past couple of months, I've been sitting on some cash, and if you've been doing the same, there's a couple of things you can do. So the best strategy, according to me, is to build a shopping list. So this is not an easy task, but these are my thoughts. This correction has come right after earnings, so you do not have to guess a company's performance. You have the earnings, and they are right in front of you. So look for companies that did not underperform the expectations of Wall Street, of course, unless it's a Max 7 name. Ideally, focus on companies that have gapped up on earnings and managed to hold those gaps. Look for companies with solid fundamentals, and speculative and low quality stocks might do well in a bull market, but in a deeper corrective move, or basically market mode, such as the one we are expecting, institutions sometimes step up in on speculative stocks, but not always. So think about the companies hyped in 2021 that did not bounce back in 2022 versus the fundamentally solid ones that later reached all-time highs. The next thing to do is focus on relative strength. So identify the names that are not getting completely wrecked by this sell-off. For example, Uber is one such name. These companies, if they avoided the heavy punishment during the downturn, are likely to perform well when the market turns positive again. So currently, many AI companies are at a deep discount, and if you believe in the AI story for the next decade, consider them too, but concentrate on the highest quality names with solid fundamentals and not the speculative ones. And remember, don't assume the leaders of 2024 will be the leaders of 2025. Use earning reports, relative strength to identify future leaders, and always diversify. While tech is hard to resist due to its prominence, consider other sectors like the financial one, and for example, gold stocks basically. Okay, that's a bit of a rant. So now to the Fed update. The Fed cut the pace of balance sheet runoff by reducing the treasury cap from 25 billion to 5 billion per month. Notably, some members are favoring the continuation of the current pace of unwind, and this signals a potential future policy divide as Powell's term ends in 2026. In the press conference, a more dovish sounding Powell offset the more hawkish tones set in the S&P, and while Powell emphasized the uncertainty and two-sided risks, the S&P revealed that 18 out of the 19 FOMC members see inflation risk skewed to the upside. So the Fed's internal risk-weighted core PCE index is now more tilted toward upside risk compared to June 2022, when they were actually hiking rates. So what needs to be kept in mind is that although unemployment risk were mentioned, 8 officials now expect just 1 or 2 cuts this year, with 4 shifting from 50 basis points cut stance. So Powell also downplayed these shifts later in the presser. Another thing to note is that rate cut expectations are narrowing, and QT, which is quantitative tightening, is slowing as the Fed remains in a holding pattern. The issue is that the Fed is holding this pattern amid persistent inflation risks and a slowing economy. And while the median forecast held 2 cuts in 2025, the average moved to just 1. And this lifts the implied policy rate to 4% from 3.84. And what needs to be noted is that more Fed officials now expect 1 or no cuts, and fewer anticipate 3 or more. And the window for 2 cuts is narrowing. So in a move before June, this looks increasingly unlikely. Maybe you are asking yourself, what's the takeaway? Well, basically, markets are adjusting to a Fed that will only act if absolutely necessary, and the Fed put is far less reliable than in previous cycles. The Fed put is basically the Fed stepping in to save the market. And although QT is slowing financial conditions, they still remain restrictive, and the Fed is reacting to incoming data rather than preemptively shaping the cycle. The last thing I want to discuss is what to do this week and what to keep an eye on this week. First of all, keep an eye on the truce negotiations between Russia and Ukraine for this mainly for European equities, but keep an eye on them. The war in Gaza for oil, and of course Donald Trump. Speaking of him, April the 2nd will matter more for the markets in the near term, and I expect tariffs to be both a tax and a negotiation tool, not either or. So likely air pockets and better entry levels before the landing zone is in sight, and some of these uncertainty related risk premium starts to be priced out, eventually consistent with US equities outperforming in a 6 to 12 month horizon. Okay, in terms of the macro calendar, the most important releases are US and EU PMIs on Monday, BOJ minutes on Tuesday. We have UK CPI on Wednesday, and the risk event of the week, which is the US jobless claims. Friday is quite macro heavy, so keep in mind with US PCE, UK economic data, and depending on where you are, Japan. So Japan CPI. So let's go to the charts. We went through Bitcoin and the levels to note. You can see them on screen. We definitely need a close above this trend line to become more bullish. Gold, as we said, retesting the breakout of 3000. USP 500, US 500 is above this level. This is a very important level, 55.24, 54.04. If this breaks, this is on the weekly, and this is likely to stop any potential sell-offs, which is 52.61. Yep, let's double check this. Calculations. Yep, 52.61. On the DAX, which is the German index, we are definitely seeing some bullish price action. The current level 22,800 is a major support, so keep that in mind when trading DAX. Yeah, that about sums it up. Thank you for watching this. If you've enjoyed the video, leave a like and subscribe.